You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host as always. This week we are doing a deep dive into the commercial real estate market across the country and more specifically in Western Australia with Ray White's Head of Research nationally, Vanessa Rader. I've seen her speak a few times. She's well regarded and sought after, and we're lucky enough to have her pop into the studio on her national road trip that you do a few times a year, Vanessa. Thanks for coming in.
Yeah, thank you.
The commercial space is one that I think in some spaces has a similar story to the residential space, just simply given the amount of money in the market and especially looking at the West Australian market too. But in others, it's not exactly the same story, given its sensitivities even more so than residential to interest rates. And we know that over the years we've spoken through the podcast the connection between interest rates and yields and how that plays out with values. So I think it's a great opportunity to have yourself in, Vanessa, to talk about what the temperature check is on these subsectors of commercial in Western Australia, but also how that's playing out across the nation and what the rest of the country thinks of Perth's commercial market right now.
Yeah, that's a really interesting question because commercial it's actually really difficult around the entire country. As we all know, there was a whole lot of investment into commercial property, no matter really what subsector you were in or what state you were in, particularly during that COVID period when financing was so low. It
made sense, right? The interest rates are 2%. I can buy something at 5 or 6%, I'm making money here.
Well, this is the thing. And there were so many people diversifying the record numbers of first-time buyers into commercial, speculating, just looking to get a better return on their investment. And they were buying a whole range of things. And, you know, with commercial, you can buy something from as small as a small little unit for a couple of $100,000 through to, you know, obviously hundreds of millions of dollars. But shopping centres, that's right. But there was, like, you know, no matter how much money you had, if it was less than $1 million through to, say, 10 or 5, there was something on offer that you could get probably at a much more attractive yield than perhaps a residential investment, which is maybe where your past has been.
Well, you think about residential, we talk about yields of 3.5% to 4%, but that's gross. That doesn't take into consideration all of the extra costs that go into residential. The thing that a lot of people still don't recognise about commercial is that when we're quoting 6%, that's a net yield, right? That essentially means 6% of the value of that property every year in your pocket before tax. When your interest rate's 2%, you can't lose.
Well, this is the thing that not a lot of people actually understood the fundamentals of investing in commercial property. So the tenant takes on the responsibility of the outgoings, even if land tax or anything is all insurances, that's the responsibility of the tenant. So yes, it looks totally attractive. And like you said, if there was that low amount of financing, you got those yields that seemed awesome.
Yeah.
But what happens though?
Things change, interest rates change.
Interest rates change. However, we have not seen the same level of growth in that yield as we have seen the financing cost. And as a result, we've seen the volume of transactions across every single asset class absolutely plummet in every single state because no one wants to sell at that different yield because that means that they're losing money.
Yeah, so put that into perspective, we were buying things at 6% or even let's say 5% in WA when the interest rates were 2%. The interest rates have now gone up to about 6% as a reflection of the cash rate from the RBA, but yields are still 6-ish.
Yes.
So it's gone from people making money on a monthly basis, simply just holding commercial property, to now probably being cash flow neutral right now when it comes to holding commercial property. And they're looking at going, well, hang on a sec, that doesn't really stack up for me.
That's exactly right. So what we've seen in the East Coast states, because you talk a little bit about that, is there's been a bit more confidence in the kind of longevity of some of these asset classes, but every single asset class is actually operating very, very differently. So there's probably more of a acceptance of those yields in, say, the East Coast markets, because they think over the longer term that's going to come back. And if I have money, maybe there's not so much financing involved, it still looks like a good option. But when you look at somewhere like WA, which they've grown their yields already from a higher base than an East Coast. If you're an East Coast investor looking to invest your money today, well, there's much more value, it appears, in the WA market. But the issue is, what is there on the market?
There seems to be a bit of a gap there, right, between, the question might be asked, well, why aren't the yields now at 9%? Why haven't they grown the same as interest? Well, because sellers won't sell them at 9%.
That's right.
So what's happening is, in a lot of classes, other than maybe industrial, there's just no transactions, as you said, right?
Yep.
A seller's not going to sell for more than 6 and a bit. A buyer's going, I'm struggling to make this work unless I'm cash.
Yeah, unless you need to. That's what we've seen. So we've seen those volumes. If you look at it, you know, a chart, it was up at however many billions of dollars and it's come down. Like it's back to lows pre-COVID level. So you can't even say it's back to a historical norm because they were, you know, outstanding times during that 2021, 2022 period. But this is the thing, unless you need to sell, you're kind of a bit reluctant to sell in this market. Unless you're maybe a long-term hold, you've held it for a long time, you want to get out. A lot of people have reasons for selling their asset. But it's sometimes when you're faced with it, I could have sold it last year or the year before for a certain price, it's hard to get your head around it to go and sell it at today's prices, because there is that adjustment in yield, which has certainly happened.
It's such an interesting conversation we're having, which you juxtapose that against the residential space right now. I always talk about non-buyer's remorse, people who don't want to buy at a mill because they could have bought it 900 grand. It's nearly a little bit of that happening in the commercial space the other way, in non-seller's remorse. I could have sold it for a yield of 5.5 last year. Now it's 6.1. I'll just hold on. But the buyer doesn't want to buy it for anything less than 6.5 maybe.
Yes.
So there's a gap there and nothing's happening. No one's selling, no one's
right.
buying
And the problem
in a lot of
is,
classes right now.
for the vendor or the owner, if they're going to get themselves into a position, it's probably better to have sold yesterday than it is to wait another couple of weeks, because then that buyer's, their requirements might change or their expectations will change the other way as well, particularly if we do see movements in interest rates again. So it's certainly an interesting time. When it comes to residential, we've seen such huge growth in the residential values, and Perth, you're leading the charge in terms of house and unit price growth.
Finally.
After such a long period of nothing.
For so many years.
But
irrelevance was probably the best way to explain WA's market until the last 3 or 4 years.
Combine that kind of growth in price and the rents, you're second highest in the country, together with Queensland in Brisbane. That is a spotlight back on to residential as an investment choice in WA. I don't know.
So that money is going from commercial to residential in WA.
Well, what we find is a lot of these investors, particularly if they're those East Coast investors, they're just chasing the yield.
Yeah, they don't really care. Is it a storage unit? Is it a 3x1? What's going to give me the best return?
It really does come down to that. You have to kind of future-proof your investment too. So something like residential in a market where you've got, high population growth, there's limited supply, that looking attractive. Whereas if you're looking at a retail shop, there may be some more hesitation around that, because historically, let's remember that yields for these commercial assets have always been higher. And why have they been higher? To factor in that risk.
What risk?
Your tenant moves out, you're not going to get another one in 2 days' time or 2 weeks' time. You're going to be sitting there for 2 years and there's going to be no one in there. And then what do? The cost of management is higher, all those sort of things. Cost to find a tenant is higher. Maybe you have to pay an incentive to attract that tenant in, where you have to lower your rent. There's different things that are fundamental in the commercial sector compared to a residential.
Well, what about WA compared to the rest of the country? There seems to be this bias. It's obvious in the yields that people will accept in the East Coast versus WA. Where we're expected to accept a yield if we're selling a commercial asset of 6 and a bit, whilst the East Coast, they're trading at 5%. Why is WA's market trading at a higher yield than the rest of the country when we have the strongest economy, we have the most population growth, we have the least supply of assets, and we have the same tenants? That's
an interesting question, and whenever I speak to people from Perth, that's exactly the comments that they make. But historically, you've been a tough state, very boom and bust-ish, and as a result, there's that little bit of extra risk that's been attached to a WA investment. Now, a lot of that has moved. You've got a really stable economy, and it's not just built on the one thing as well. Like, there is kind of diversification in where your investment comes from and your returns. But it's a hard one, because those East Coast states, particularly Sydney and Melbourne, are just seen as the premier locations. They're the premier locations. They historically have trended more stably. As a result, some people might be willing to take a little bit of a haircut today for the future prospect of capital growth that historically has been greater in those East Coast markets compared to a WA.
Could you also argue the other way, that an East Coast investor looks at WA and goes, well, these guys are flying and I get a higher yield? Sign me up.
Yeah, well, this is what we're starting to see. And what you can see is, particularly in the commercial side of the investment, is these buyers agents in particular coming in and educating kind of a lot of these East Coast investors into different markets like WA and helping them to invest their money to get that greater return. Because really now is the time. If you have the ability to purchase something and you can find something at that appropriate yield, it looks like good buying.
Wouldn't the advice be that I would have thought, if a buyer's agent is trying to convince a buyer from the East Coast to buy in WA, to go, well, look, there's a little bit of hesitancy right now in the buying space on the market around are we going to have an interest rate rise in the next few months? However, I think most people would expect that over the midterm, interest rates will be lower. So this would be an opportunity right now for someone buying commercial property to take advantage of that little bit of uncertainty right now, to go, well, bang, I might be able to jag something for 6.5%, whereas the second interest rates start dropping that's going to get a lot harder for me to do
Oh,
that.
there's no doubt about that, but it's whether or not you can find that asset, and there really hasn't been enough transactions. But it totally makes sense to do that because a lot of these buyers agents, they are quite good at doing the research, but understanding that commercial property, just like any property, is usually a long-term play. If you go in it for a short win, or particularly in a market that historically has been boom and bust, you're going to possibly get hurt. The risk is high. But if you're looking at buying something today, and maybe it's a little bit higher than you would have thought it was, but over the longer term, if you hold it for 10 or 20 years, or it's a generational asset you can give to your family, which is a lot of what these investors are doing, it still looks like good value.
When we think about who the buyers are in this space, let's say it's between $1 million and $10 million. They are, from my understanding, they can be family offices, but a lot of them, families who have made some money over time, have got a bunch of cash sitting in their account. They don't want to put it into shares. They look at it and go, oh, look, childcare centre, 15 years of 6% growing by 3% a year. That's not bad.
Well, it's what we call...
there's your return. There's your pension.
That's set and forget is what we say. Like, it costs, they've got none of those outgoing costs, like we said. They don't have to worry about it. They just know that they're going to get
every
an income.
Every year they get $300,000 coming
or
in.
there's going to be fixed increases of whatever it is, and you know that it's going to be there and you're going to be set and you don't have to think about it. Yeah. So that's why investments like childcare have been particularly popular, because they've got that certainty and income stream. It does make sense, particularly because there's a lot of cash-rich people out there that are looking to buy. But on the other side, there are a lot of people that are obviously borrowing a lot of money to invest in this thing. And if you're looking at buying something, why not that regular income stream, certainty and income stream? It really takes a lot of the risk out. So that's why some of these investments sometimes attract a little bit of a lower yield.
We spoke about childcare just then, but we've also noted in Western Australia, a lot of petrol stations have popped up over the last few years. And also a proliferation of some newish fast food chains as well. Seen quite a proliferation of new retail offerings. What's the market looking like in WA compared to the rest of the country, or just generally around the country? What's the feel right now in those spaces?
If you've got a standalone supermarket anywhere in the country, that's really highly sought after. So the yields are going to be tighter on that. They're going to be sub 6% for something like that.
Is more consumerism?
Well, but because people are spending money. Like, we have a growing population. They are going to the supermarket. They are buying their goods. You feel confidence that tenant is going to be there in situ for quite some time, particularly if it's a new centre. It's probably built with a growing residential community around it. So that seems like a good investment. Also, backed by an Audi or Woolworths, like who wouldn't want to be associated with an investment like that? Fast food is actually another one of those same things. If you've got a fast food outlet attached to a really big brand name, you're looking sub 5%. We are spending money on fast food, continuing to spend money on fast food. It's not going to go away. And if you've got a Hungry Jack's or a McDonald's, if it's McDonald's, it's going to be even tighter again. But that seems like good buying.
A lot of people wouldn't realise you can own a Hungry Jack's.
Yeah, you can
own a KFC. They will build the building. KFC will rent that building off of you, and you can roll around and saying, hey, I own a KFC.
Well, and that's the thing. And that's also another one of these set and forget. All the KFCs look the same. It's because they do all that work. You don't have to do it. You don't have to put any money into it. They do that. They maintain it. If they need to change their signage, they do all of that. There's no outlay from the owner to have to do that. If you can snag one of those, which they don't come to the market very often, when they do, they are really hotly contested, so the yields do go down really regardless where you are in the country. And then service stations is the last one. And service stations is a really interesting one because service stations were really hot before childcare was hot quite some time ago.
Why?
Everyone liked they were well located, kind of like main road locations, often corner locations. Again, set and forget. You were attached to a lease from a big brand, usually 7-Eleven or a BP or Caltex, whoever it is. You had certainty on the income, and they were always like 10 plus 10 plus 5 lease arrangements. So that's a huge amount of time. You do not have to worry about it. You're just going to be taking that income, regular increases in rents. That seems like a really good investment. However, you have to remember also that had contamination issues. Like, let's remember what's there in those underground in these facilities. So while it is a good location, it could get possibly redeveloped. There would probably be some remediation needed, and it's probably not that easy to do that. However, as time passed on, we saw that LVRs got really hard in terms of the financing. So financing really dropped off. So if you wanted to buy a service station, you really needed to come up with 50% of the cash.
Not everyone has
50% of the cash. Yeah, that's it. So that's why we saw a pivot to something like a childcare centre, which is a little bit more friendly in that regard. But it hasn't been that service stations are any less attractive. And we continue to build more service stations as well. So we're needing the space.
That's a bit strange to me if we're moving to EVs.
Let's talk about EVs.
We should be building more petrol stations. It's always confused me a little bit.
Yeah, so EVs, just to be really clear, it represent about 1% of the entire car population in Australia. In WA, it's probably a little bit worse compared to a lot of other states.
Yep.
A lot of space to cover across the state. The charging is a massive issue. A lot of states are doing lots of different things to encourage subsidies and whatnot, to encourage the purchase of EV vehicles. It will continue to grow. There's no doubt about it, but it's a very, very slow burn. So our requirement for a service station or a petrol station is not going to go anytime soon. It will be here for quite some time.
I just have a concern that at some point, we talk about these being long-term assets. At some point in that lease term, the nature about how we interact with transport, petrol versus EVs, it might not be now, it might not be 10 years from now, but at some point we will probably get to that. And there may be an iPhone-esque event or a digital camera Kodak event where just one year we all had Kodak cameras, the next year none of us had cameras. I think at some point in time we might get to that precipice, and then you have to ask the question, well, whilst a fuel station is a convenience store and that's where most of their money is made, selling Maltesers and giant snakes, they still need a reason for people to stop there in the first place. And unless they're going to transition to a supercharging station for EVs, which they may, that may be the strategy.
Yes.
At some point, the petrol bowser will go.
But I do think that supercharging, like you said, is going to be something that's really important, and it will still have a need. And we'll see those convenience stores to offer more maybe fast food, and they kind of expand their offerings for people that are sitting there and waiting, or some sort of entertainment type facility. Yeah. Because at that point, in that far into the future, we hope that kind of fast charging is super fast and we're not having to sit there for half an hour.
Minutes,
that will be okay. But the other piece of that to remember is that these are on quality sites and they could be redeveloped. So
they're always right at the corner of a highway intersection.
Exactly. You can future-proof the assets just if you be considerate with the location that you're buying them in. The other thing I'll just mention as well is about the charging. Charging is going to become an increasing issue for everybody, everywhere. If everyone has got EVs, let's say, not everybody has access to their own charger in their own home. There's people that will be living in apartment buildings.
Don't have any power in my apartment building.
Like if you wanted to go put an EV in your apartment building, it would be an absolute nightmare to get through your body corporate. Who pays? Well, obviously you have to pay for it, but then it's being able to do all that's very expensive to do that. Yeah. I understand that technology will improve and allow that to happen more. But people that don't have dedicated garage or something to do it, what do? You can't stick it out in the street. There is a lot of issues, and WA maybe not so much as some of the other cities that have maybe a lot of terrace housing and thing where there isn't somewhere for their car to go. How do you deal with the charging? So I think that the requirement for service stations is not going to be one that goes away anytime soon.
What about the office space? Oh, it's an awkward thing, I think, to talk about because they're huge investments, huge assets that are too valuable to knock down in most cases. As much as people suggest, we can renovate them and retrofit them, we can't. You can't turn it into residential without it being more expensive than knocking it down in the first place. But at the same time, we're still building A-grade, premium-grade offices in the terrace. The demand for the B and C-grade stuff seems to fall away over time. I don't really hold a lot of hope out for the owners of B and C-grade office anywhere in the country, let alone WA. I'm
a bit down on office also. It is, particularly those secondary grade assets, it's going to take a long time for those to be absorbed if they remain an office building. I echo your sentiments. You can't just turn these into like residential or student accommodation easily, roll it over and start again, which is obviously very, very costly and not what people want to hear. Yeah, the office sector is tough. We have a real change in the way that people interact with their office space. I'd say that of all the markets, Perth in particular is probably in the best standing because your work from home rate is not like other places. And so because you didn't have the lockdowns and things the same way. But there is absolutely no doubt with the continued construction that we're seeing across the city, all those kind of newer buildings, all the premium grade buildings, the A-grade buildings will continue to get those tenants move into them. And then we're going to have a real difficult time for those secondary grade buildings. And it's B, C and D, which make up a big amount of our stock in the CBD.
Yeah, anything not renovated in the last 10 years, really.
Oh, it's even less than that. Like, it's really the flight to quality. I really don't like that term, but it's true and it's happening. And there is deals to be had. But if it is that high quality stuff, it will get absorbed. It will take time, but it will get absorbed. Incentives have remained high across the office market for, a prolonged period of time. Vacancies have remained high for quite some time.
So free rent, essentially, is what you're saying?
Well, I don't want to say that. Like, I think the whole idea of incentives is really silly, but
that's the reality.
That's
when
we
talk
talk
about incentives, we talk about, here's a 5-year lease, the first year's free.
Yeah, but the thing is, and they also want the fit out as well.
Yeah.
So like we're spec fitting out space to try to attract the tenant, and then the tenant's taking that fit out, enjoying the use of the fit out, and also asking for the rent-free period as well. So like that's double dipping again. So it's a difficult time for the office market, and it's not a WA thing. It's everywhere. If you go to Melbourne's the worst market in the world. People do not go to work there as much as they say that's improving. It really isn't. And Sydney as well. Like I'm a Sydney sider, and it is quiet. And the best bellwether for a lot of these things is looking at parking. I look at parking rates in, say, Sydney and Melbourne, and they're some of the cheapest that they've been in the last 10 years. If there was demand to be in those parking spaces, they wouldn't be discounting them. And if you do it online, they give you an extra 50% off again. So
Wow.
we're not even looking at that part. So Brisbane's currently got the highest parking rate of anywhere in the country.
They also have the worst traffic situation as well.
Well, now they've done
the town planner started that place back in the early 1900s.
But now
made some mistakes.
But also with the state government bringing in the 50-cent public transport in Queensland too, trying to generate that activity back into the city, they haven't got as big a issue with that work from home. That's a much more vibrant city on a normal day compared to say a Melbourne and Sydney.
Yeah.
But yeah, the office market, if you're the premier end of town, premium assets, and they still hold that trophy status. Like there is still investment by particularly offshore groups or institutions will all be looking for those assets. But yeah, anything that's B and below certainly is going to be a tough time for a little while, because I just think it's like a structural shift in terms of the way that we interact with space. So because there's been that shift, that work from home, which wasn't a thing. Like it wasn't a thing. If you were offered a job prior to COVID and they said to you, hey, you could work from home 50% of the time, you'd be cheering. CBA tells their staff to come in 50% of the time. They get the unions involved. Like what's that about? Like it's a complete shift. And we're not even talking about what's that going to mean for the education and our neck load of workforce that is just not spending time learning in an office environment.
Well, let's talk about the industrial space. Something a little bit less negative. We spoke to Wayne Chorley a few weeks ago, who's one of the leading local industrial sales and leasing agents in Western Australia. He's been around as longer than I've been alive, and he said this is the best market he's seen. And we chatted a year and a half ago, and that was the same thing he said then. It doesn't seem to be getting any looser in the industrial space. Would you suggest that a lot of the money in commercial, if it's not buying in the industrial space, it's trying to buy in the industrial space?
There's no doubt. Industrial is the shining light of all the...
Is this national?
Yeah, nationally, it's certainly the case. And some markets it's a supply. It's very supply driven. And somewhere like WA and a Sydney market, for example, very constrained market in terms of land supply, land availability. Cost of construction is high everywhere. When you have a situation where vacancy is so low and the pipeline of new supply is so limited, we're seeing rents continue to increase, not as much as they were increasing, saying when he spoke to him a year and a half ago, but they are continuing to increase.
Well, we're seeing records here that no one would have ever even imagined.
Yeah. Oh no, the records has happened everywhere. Anywhere that's got that constrained supply piece is probably seeing a better result. So WA is certainly one that falls into that category, because not only do you need the supply of land, you need that land to be serviced. This is the kind of the roadblock that we're seeing with a lot of developers trying to actually develop this land, is the servicing, the cost of construction. There's quite a costly exercise to bring new products out of the ground. So that as a result, it requires a new level of rent, like an economic rent, if you like, to allow you to even build it. Otherwise it's not feasible and it falls over. So yeah, it's definitely the investment choice of the entire country. WA in particular, like I said, with the supply issues, and somewhere like Sydney supply issues. Melbourne has land as far as the eye can see. You can stand on a ladder and see Adelaide. That's why they haven't got as much kind of housing stress and stuff there as well, because there is a land availability and zoning to allow that kind of to happen. Yeah, even to some extent Queensland, southeast Queensland, constrained with industrial, but we've seen record prices in terms of value and yields. Yields got down to really, really low. They have gone up because that cost of financing piece is there, but they're still pretty tight when it comes to industrial versus any other commercial asset class.
If you had a couple of $1 million sitting around, where would you be putting it nationally right now, and in what asset class?
I like storage. Actually would be a bit of a winner, because that's industrial, but it really lends itself to the need that we have across the country, and particularly in Perth when it comes to residential. So people having to move from home to home, downsizing. So there's going to be this need for that storage facility, keeping occupancy up. Rents are pretty high for those assets. So yeah, they're attractive ones. And like at the end of the day, you can have big facilities on industrial land. They can be reused into something else industrial. But I'd say it's a little bit left of centre, but I don't mind.
No, I definitely am on the same page with you there. It's a very easy business to run, or when you're leasing it out to someone, they only got a couple of storemen looking after the whole place.
Yeah.
And it's a hedge against inflation as well. I mean, you charge for it on a monthly basis. It goes up as the market goes up. It goes down as the market goes down. So, but at the same time, steel frame building you spent $10 million on in 2024 is still the same steel frame building in 2050, which would cost a lot more, I assume, at that point too. So I definitely think something like self-storage, if you can find the land for it and be in the right locations, is a winner and something that is nearly a set and forget as well.
Yeah,
first place.
That's right. So the key is there that you always look for a bit of a long-term plan when you invest in commercial. Like, you're more likely to find yourself in trouble if you're looking for a short term, you think you're going to make some money quickly.
Yep.
But if you have a longer term strategy attached to any sort of investment, you're probably going to steer in the right way. Also, when we're talking about industrial, those buildings, they're so expensive to redevelop now. So even if it's a secondary asset, the fact that you actually have a structure on there is going to be,
which
a
is
good
similar to
news story.
residential, right? At the moment, you're paying massive money for a 50-year-old 3x1 in a suburb 30 k's from the city, simply because of the cost to replace that thing 5 years ago. You were nearly getting the house for free.
So a lot of the time, secondary industrial was always frowned upon, whereas now if you can get that return and continue nicely along for the next little while, then redevelop at that site. Well, then that's a good news story, as long as that's a long-term play.
Vanessa Rader, thank you so much for coming in today. Appreciate the roadshow you continually make to Western Australia. A lot of people on the East Coast either forget about us or aren't too worried about us, but and I know that that we're a massive part of this economy and a very interesting market to be a part of.
Yeah, it's for sure.
Thank you very much for your time, and I'm sure we'll have a chat again in the future.
Thanks.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!